VA borrowers. My name is Steve Doherty. I'm the Raleigh VA loan guy, Marine Corps veteran, here to answer some questions about your VA entitlement. So, on a VA loan, you do not need a down payment because it is a 100% financing option. So, what exactly does that mean? If a home costs $250,000, you can get a loan for $250,000 without having to make a down payment. Could you pay a funding fee? Perhaps. We've covered that in other videos. So, how much cash do you need to buy a home if the VA offers 100% financing? Well, there are other expenses associated with purchasing a home, namely closing costs, prepaids, and escrows. You probably just hear these referred to as closing costs, which are fees associated with the transaction itself. Prepaids, escrows, that's really taxes, insurance, and interest that's collected at the closing table, but is more related to the expenses of home ownership going forward, starting the day that you get the keys to your house. So, how much should you budget for those? This can vary a lot area to area as taxes and insurance, attorneys' fees, title insurance fees, all that stuff can vary market to market. You want to talk to a local VA lender who can accurately forecast those expenses. Now, is it possible to have those expenses paid by someone else? It is, but you probably can't guarantee it. And again, this can vary a lot market to market. You want to talk to a local realtor who is familiar with the market and understands how competitive that market is. Why does the competition factor in a market weigh into whether or not you can have those costs paid for? Well, when you purchase a home and you get under contract, part of the terms of your offer could be that you're asking the seller to pay for your closing costs. And assuming that that concession or that credit falls within under a certain limit, that's perfectly permissible. However, you have to negotiate that, and your realtor has to convince the seller to still accept your offer while paying for those costs. Another way you can have those costs paid for is through a lender credit. Lender credits are generally created when a mortgage lender increases your interest rate. Increasing the interest rate is sort of the opposite of buying points. When you pay points, you pay a fee to reduce the interest rate. Well, the inverse is kind of true as well, meaning, generally speaking, if you increase the interest rate, that can create cash that you can use to offset the expenses of closing costs, prepaids, and escrows. Now, are those always available? No, it kind of depends on market conditions. Sometimes we can't raise that interest rate, or sometimes we would have to raise the interest rate by such a large factor that the credit that is generated just isn't worth it. For instance, if you could raise the interest rate by 0.25 and get a $5,000 lender credit, assuming that is compliant, that would be a pretty good deal. But if you had to raise the interest rate by a point and a half, only to get a $500 lender credit, well, that would be a pretty bad deal. So lender credits, seller credits, can they be used to offset closing costs, prepaids, and escrows? Yes, but you can't, no pun intended, bank on them. You're going to want to talk to a local real estate expert and a local mortgage loan expert who is well versed in VA lending. Again, my name is Steve Doherty. I'm the Raleigh VA loan guy. Thanks for tuning in. Check in again next week for more VA loan videos. Thank you.